Thank you for joining us. My name is Michael Thompson from Copperleaf Financial here in Williston, Vermont. My guest today is Apollo Lupescu from Dimensional Fund Advisors. There's Apollo. Apollo, thank you for joining.
Michael, good to see you.
Yeah, thank you. Apollo is part of Dimensional Fund Advisors, who is one of our key partners, one of our core partners. Dimensional manages about $600 billion in assets for clients, just like our clients, just like you guys. And Apollo has been with Dimensional for about 17 years, has a PhD in economics and finance from UC Santa Barbara, and is on the faculty, I think, from time to time, teaching as well. So Apollo is a real expert in economics, what's going on in the markets, and we're thrilled to have him joining us today for our town hall. And I've got a few questions that I'm going to be asking Apollo. I want to encourage all of you to ask questions as you go, and you'll be able to do that by clicking on the Q&A box at the bottom of your screen and just posting your questions. We'll get those. I'll pick those up, and we'll address those as they go. And at the end, we'll have time to check in to see if there are any remaining questions. I'll also let you know that we're recording this session, and we'll be posting this on our website after the session. It takes a few days to get it up and get it posted. And next month, in the middle of the month, we have our next session coming up, and our topic will be sustainable investing. We have a couple of guests I'm really looking forward to for next month. So thanks everybody for joining. Well, I'm going to kick things off and start, Apollo, if you don't mind. I'm tempted to call you Dr. Lupescu. My father was a PhD, and he insisted on being called Dr. Thompson, but I'll resist because I know we've chatted and met you before. So if you don't mind, I'll call you Apollo.
I'd love that.
One of the things that our clients wonder about, and I hear about from time to time, is, markets appear to be in an all-time high. And is now a good time to invest or not? Or should we be concerned that markets appear to be at an all-time high? What are your thoughts about that?
Yeah, no, it's a really good question because it seems like over the past year the market's been going up and up and up, and you open up the paper or you look at the social media or the regular media, and you hear this market's hit another all-time high, and I think the natural tendency is to wonder, well, isn't it the case that at some point this party's going to be over and and perhaps we can do something to protect ourselves when the market might go down? So it's a very legitimate question, and the first place where when I started looking at this, it just really hit me that all-time highs happen all around us. I mean, today, Michael, we've reached an all-time high of how many days we've been alive, how many gallons of milk we drink as a planet, how many people live on this planet, how many dollars are in circulation. So all-time highs happen around us all the time, and we generally don't stop and wonder about it. Now, the stock market, what's interesting is that it's not a linear climb. It's not that every day it's an all-time high. It's 4 steps forwards, 1 back, then another 5 forward, 2 back. It's a pretty random pattern, but the trend of the market has been up and hitting an all-time high. It's not necessarily that unusual. In fact, Michael, I'm 52 years old, so I was born in 1969, and a couple of years ago when I turned 50, obviously the big event was that somehow my name coincides with the landing on the moon.
Right.
I got this booklet about all the things that happened in 1969, and one of the paragraphs there was about the stock market. And at the time when I was born, the market, the Dow Jones, was roughly at about 1,000. Today it's at 35,000. Well, think about this. People around might have thought, boy, it went from 1,000 to, let's say, 2,000. That's crazy. How high can it possibly go? And then 3,000 and 4,000 and 5,000. And every time we reach these, people stop to wonder, wow, this is crazy. How high can it go? Well, recently it was at 35,000, and there's no reason to believe that it's going to stop. So the fact that it's an all-time high, it's not really something that is that unusual. It's happening all around us. It's been happening in the market for a long time, but it's not a linear. It's not that every single day it goes up and up and up. So markets being an all-time high should not necessarily be that much of an issue. And generally speaking, one of the statistics that I find interesting is, roughly speaking, about 1 in 3 months, historically, going back to 1920s and looking at the S&P 500, which is a broad measure of the U.S. market, 1 in 3 months, it's been an all-time high. So all-time highs do happen, but it is an important question. Should it be doing something about it? And the answer is a little bit more complicated. The answer is depends. When the market hit all-time highs, in some cases, it might be justified to actually trim some of these gains as the market's been going up. And this is not done on a pretty random basis. In fact, I know that you folks at Copperleaf and advisors have a strategy that basically says that we want to have a certain equilibrium, a certain balance between different components in the portfolio. And as one of them starts going up and up and up, well, it starts to increase in percentage relative to the other investments in an allocation. And at that point, it might be the case that you trim the gains, you take some chips off the table with these markets highs, and then you go buy something that has a lower weight and perhaps is a better valuation. And this is a very systematic process. As I said, it's not done ad hoc. It's not reactive, but it's basically a process that is established in advance, and it is called rebalancing. Yep. So in that respect, an all-time high is something on the radar of the advisor, and it is possible that in certain situations, it might trigger a sale. The thing is, it's only a portion. It's a trim. It's a haircut. It's not a shave.
Yep.
It's a great thing about it. It's a haircut, not a shave. And the reason for that is that we looked at this. Should he perhaps sell the entire position? And when we looked at this issue, and it's a very interesting statistic, we looked at what happens with an investment in the stock market in the S&P 500 if you invest exactly when the market hits an all-time high. And then you fast forward 1 year, you fast forward 3 years, you fast forward 5 years to see what happens. And I'm going to use the 3-year numbers. I can certainly send Michael the data with the details, but I'll give you the gist of it. And it's quite interesting when you look at the 3-year mark, and you look at what these numbers show is that after 3 years, if you invest at an all-time high, what happens is that about 85% of the time you would end up having more money in your account. So you went up in value from the time that you invested at an all-time high. And this is 3 years out. And by how much? Roughly about a 10.5% increase return per year over those 3 years once you invest at an all-time high. But you can also say, well, what happens if I invest in any month, any good old month? How would that be different? Well, what you see is that roughly about 85% of the time, you're going to have more money. And by how much? Roughly about 10.5%. In other words, there seems to be absolutely no difference between investing at an all-time high or investing in any good old month. And that's a really important thing to remember, that investing in all-time highs is not necessarily something that is that unusual. And we do see that the outcome is roughly the same. And beyond that, the last thing I'll tell you is not just the data, but intuitively. The problem is if you decide to do a shave rather than a haircut, the problem is that if you sell everything, you have to make a decision on when do you get back in the market. Right. And that's a really tough decision to make. So ultimately, the answer to your question, all-time highs are not that terribly unusual. They happen in everyday life and in the market. And when that happens, an advisor, perhaps can look and see for your situation, is there a reason to trim and rebalance? But people should avoid an entire sell of the position. And it's because we don't know to get back in, but also because you're so focused on taxes and cost. Whenever you sell a position, people should remember that you have to pay taxes if you have any taxable gain on those. You have transaction costs, and it's a hassle. And then not knowing when to get back in, but ultimately, Michael, I'm going to wrap it up. But Michael, I can tell you there will be at some point a market downturn, because it's never been the case that the market goes up every single month, every single year. It's always the case that at some point there's a pullback, or whatever you want to call it. But it's very similar to a situation like where I live here in Los Angeles. I know at some point there will be an earthquake. I'm under
Right.
no illusion that I won't see an earthquake. I'll see an earthquake. The trouble is the same with the stock market. I just don't know when. And
Right.
rather than live my life in panic, well, I'll focus on the things that I can control. I'll
Yep.
bolt the house to foundation. I'll, tie the shelves to wall, have water in the trunk. And that's what you're trying to do with the allocation of portfolios. Focus on the things that you can control. And when that day comes, it might not be pleasant, but it's not devastating because you did prepare for that.
Such good points, Apollo. Thank you so much for that. One of the things I have to say that I really appreciate about Dimensional is how data-driven you guys are. And when it comes to research, you talked about the research that you guys had done around this market timing issue. I know without a doubt, we practice what we call evidence-based investing, which our clients all know. And you guys are such a rich source of that data. And I know that when we go to you and I have a question like this, that the answers are going to come from facts. They're going to come from data that you've been able to do the research, help us scour the research that's available. And we can rely on those facts rather than sort of opinion, which may or may not be meaningless. And one of the things I also love about what you just showed us is, there is so much inclination in the financial media and in the popular culture about the importance of market timing. Oh my gosh, things are high, should I sell? Oh my gosh, things are high, should I buy? And what you've just been able to show us is, in the long run, it sort of doesn't matter. In the long run, we know what the trend is, and the data show that what's most important is to have a plan, have an allocation and investment policy that allows us to apply the math and apply the science to the proper allocation, and to kind of stick with it and keep focused on the long term. So thank you for that.
Oh, and I guess to add one note to this, it's also about having an advisor, because quite often the emotions can overtake us, and not having an advisor can be incredibly detrimental to an investor. So, working with Michael and the team, I think that it's not just having that consistent discipline approach, but also the rebalancing is extremely important. So, the one thing that I would have added is just the importance of working with an advisor through all these market ups and downs.
Well, thank you for that. We certainly believe it, and it's certainly proven to be the case. And we do periodically rebalance, and we rebalance back to the model. We do it opportunistically when those asset classes kind of push out against our what we call our guardrails, and we bring it back to the model. We harvest some profits and allocate more dollars to those underperforming asset classes. One of the things that you brought up that I think is really interesting, you talked about the S&P 500, and you actually touched on the Dow Jones in your explanation a minute ago. And I know that last year, this can be very confusing for clients. And last year, for example, I know in 2020, the S&P 500 was up about the Dow Jones, I think, was up about 7%. I think the S&P was about 16% to the positive. And I think the NASDAQ was up about 44%. And what I wonder for you is, what's the difference? What's the difference between those two things? And what actually is the market? What should our clients be focused on when they're trying to measure their own performance and understand what the heck the market is anyway?
Right, because particularly since, even like if you watch today, whatever any given day, it seems like the three metrics that are most used by the media, the Dow Jones, NASDAQ, and S&P, they diverge. They're quite off every single day. They're not the same, and it could become confusing. Why is it that they're so different? So I think it's a phenomenal question, because it also drives to look at any own performance, and if you compare it to the market, is that the best way to do it? Well, the way that we look at Dimensional, again, it's a very data-driven approach, but the way we look at at Dimensional is that the stock market gives all of us a stake in capitalism, meaning it allows us to buy ownership into companies, and that's beautiful, and it's a fundamental premise of the stock market, allowing people to participate in the ownership of beautiful American companies. And in that respect, when you look at the stock market, what really the market is to us, it's an aggregation of all these companies that have opened up ownership to individual investors in the U.S. And by that, when you look at the actual numbers, what you see is that the stock market is basically about 3,000 different companies in the U.S. that have opened up their ownership. That to us is the stock market. All these companies that you can buy and sell. Now, not all companies are exactly the same size, and because they're not exactly the same size, you look and you want to measure based on their size. The larger the company, the greater the emphasis that you want to put onto that stock. And in that respect, the largest 5 stocks are Apple, Microsoft, Amazon, Google, and Facebook. And together, they amount to about 17% of the value of the entire stock market. So that is the market to us. Very comprehensive, covering all the stocks that you can buy, legitimate stocks. We're not talking about penny stocks or anything like that. Now, what you hear most often on the news is exactly what you said, the Dow Jones. So what is a Dow Jones? Well, Dow Jones is a subset of 30 companies out of 3,500 companies. And even as they're large blue chip stocks, in terms of how comprehensive it is, it's not very, because these companies amount to only less than a quarter of the value of all companies that you can buy in the US. So very shallow, very, very shallow measure, both in terms of the number of companies and also in terms of the overall coverage of the market. And what's interesting is, as opposed to the way we look at it, which is the greatest company, the larger the company, the greater the emphasis, what they care here is much more about the stock price. And the stock price is something that the company can determine, because it's like a pizza pie. You can cut in any number of slices you want. And in that respect, these are the 5 largest holdings in the Dow: United Healthcare, Home Depot, Goldman, Amgen, and Salesforce. And the reason I mention this is that quite often people are saying and looking at the market and looking at the Dow, how did the market do? How did the Dow do? Well, I have to say, folks, this is not the best way to go, because first of all, 3 out of the largest 5 stocks in the US market by capitalization, Amazon, Google, and Facebook, are not even part of the Dow. The largest stock, over $2 trillion in Apple, it's the 18th largest holding out of 30 in the Dow Jones. So by that metric, is it really how we want to measure the market? 30 out of 3,000, and not only that, but you 3 out of the largest 5. Like, how can you measure the market without putting Amazon, Google, or Facebook in there? Right. And because of that, a lot of professionals do not use the Dow. Now, we also hear a lot about NASDAQ, and NASDAQ represents all the companies that have chosen NASDAQ as a trading venue. And there's some technology, there's some non-technology stocks. And there are about 2,000 plus different companies there. And if you look at the size here, and what they do is they actually do measure the performance of NASDAQ based on capitalization, meaning how large the companies are. Once again, you see the largest represent the biggest holding. But you look at the value of NASDAQ, it's less than half of the value of all stocks. But what's remarkable about NASDAQ is that these 5 companies, the largest 5 companies, represent a whopping 37% of the value of NASDAQ. 37% from 5 stocks. 5 companies not only represent 37% of NASDAQ, but the 37% of the performance is driven by these 5 companies. And then you have the S&P 500, which is much more comprehensive in terms of percentage of coverage of the value of stocks. It doesn't have as many names, 500 companies, but because they're the largest companies in the U.S., you do see that these are the 5 top stocks are there. And even in the S&P, about 22% of the value of S&P comes from these 5 stocks. And what you mentioned earlier is so interesting, because when we looked at last year, and I'll come back to this because it's really important. When you look at what we did last year, and you see these 5 companies and how they did, it's quite remarkable. Last year, at the beginning of the year, actually through 2020, what you saw is that the S&P in 2020 was up about 18%, but these 5 largest stocks were up an incredible 40%. 49% on average between the 5 of them. So
Yep.
they did incredibly well, incredibly well. And the reason that I mentioned this is because when you look at the the way that these market metrics are constructed, in the case of the Dow Jones, they basically missed 3 out of the 5. So that's why they had the lowest, the lowest was the Dow Jones, because they missed 3 out of the 5. Then you had the S&P that had them, but at 22%. And that's where NASDAQ did so remarkably well. Is NASDAQ did so much better than the market as a whole and the S&P, not because of anything else, but just because they're so concentrated. They are so concentrated into these 5 companies. And I think that's really important to know. The reason you saw this discrepancy in performance is because the concentration that NASDAQ had into these 5 large stocks. But what's also interesting, Michael, is that the way we look at it is not just the US, but there's a global opportunity set. And in that respect, if you look at the global stock market, instead of 3,000 companies, when you add up about 40 plus different stock markets, what you see there are about 15,000 global stocks. This is the global productive capacity. And in that respect, these companies, the Apple, Microsoft, Google, Amazon, and Facebook, they are still the largest. But here comes the big difference. The big difference is that when you further diversify, the US market is only about 55% of the global value of companies. And what it does, it further reduces the weight of these companies. It diversifies them more. So in that respect, if you're going to compare your globally diversified portfolio with the Dow Jones, well, certainly it doesn't make much sense because you have 30 stocks out of 15,000. Right. But also, if you compare yourself with NASDAQ, well, you are going to have exactly the same largest 5 stocks. The difference is that instead of 37%, you're going to own 9%. And last year, that was good for NASDAQ because these companies were flying high. This year is exactly the opposite. These companies don't seem to be doing as well as they did last year. So because of that, you got to be careful not to go too much into any one direction, but stay diversified. And that is the reason that quite often when you look at your statement and you see a different result than what you see on the news, it's not that anything went wrong. It's everything is what it's supposed to be, because you're much more diversified. That piece that you see on the news is one component of your portfolio, but you have so much more beyond the stocks on the news.
That's such a good point. And also, Apollo, why in our portfolios, we try to maintain no more than about 60% US focus, US bias, and we're broadly, globally diversified. And I always tell people, instead of owning a half a dozen or a dozen different companies in your portfolio, you're likely going to own 9, 10, 12, 15,000 different companies in your portfolio, which brings up another interesting question, which is because these 5 or 6 high-tech stocks have done so well and have been so dominant over the most recent period. I wonder if you can help me answer for our clients why we tend to have a bias towards tilting our portfolios towards smaller companies and towards things that we call value companies, and yet these small handful of high-tech companies are kind of the opposite of that.
Right.
Well, can you help me make sense of that? Help us make sense of that. Why would we prefer to kind of focus on value and small cap and even global diversification when the opportunity, some people could argue, is really in a handful of large tech companies?
Yeah, so there are a few reasons, and I'll touch on that. So let's start with this idea of what is a small cap, why value, what's the difference between all of them? So when you look at the stock market as a whole, it's about the ownership in companies. But as an investor, we also realize that not all companies are the same, not all stocks are the same. So there have to be some differences between them that lead to also some differences in what we expect to get as investors. And because of that, one of the big challenges to the academic community and to the practitioners is to delineate what are the characteristics of stocks that really matter. And starting back in the 1980s, there was this idea that the size of the company really matters. And in that respect, an academic pointed out in his PhD thesis at University of Chicago that the size of the company matters, that you have these large companies that are mature, well established, like a McDonald's or Apple or Google and Coca-Cola, but there also are right now roughly about 2,000 other smaller companies which are not part of the S&P. The S&P typically covers just the largest companies. So you have this basket of stocks that are large, but there are others that are not part of the S&P. They are smaller. So smaller companies, they do tend to have perhaps a larger opportunity to grow. And a good example is if you think of large caps as McDonald's, well, small cap can be associated, let's say, with Shake Shack, which is another burger joint, and they're both publicly traded companies. And at that point, you can kind of see, that they're in the same business, but McDonald's, it's a mature company. It's been a while for a long time. It's got a track record. Shake Shack, not as long track record. But if you think of which one has the opportunity to grow and perhaps double in size easier, well, a lot of folks would say that Shake Shack might have that opportunity. So in that respect, what we saw is that investors, there is something about the size of the company. And when this academic examined it, he found that there is not just an economic intuition, but there's data. And we have this book. It's a fantastic book. It's called The Matrix Book. It's a big book of numbers, and you're very familiar with it, Michael. So I don't know dwell too much on it. But this is a fantastic book because it allows us to see what happened if you had invested in large companies versus small companies going back to the 1920s. So when we looked at those numbers, what we saw is that $1 invested in large companies, roughly speaking, would have grown to about $10,000 going back to 1920s. So really a tremendous growth in large companies. Now, the same dollar invested over the same time period, but in the small categories, the small cap stocks would have grown to roughly about $30,000. So significantly greater growth in small caps rather than in large caps, as we fondly refer to them, small caps and large caps. So the first thing is that there is an economic intuition. There is data to suggest that it is. For an investor, you are better off, distinguishing between these large caps and small cap, and then you can make an informed decision. Do I want to buy the S&P, or do I also want to put some money into small companies? And if you do want to have higher expected returns, putting some money into small caps might make sense. Now, in the 1980s, the question was, what about all the large caps and what about all the small caps? Are they exactly the same? And what we academics determined is that there's one more delineation, which has to do with the price. How much are you paying as an investor to buy some sort of an accounting fundamental, like the book value of a company or earnings or dividends? In companies that have a low price, they're called value stocks, and historically they've outperformed the more expensive counterparts called growth. So knowing that small beats large, value has outperformed growth historically. Obviously, the one part of the market that ought to give investors the biggest bang for the buck is small and value. And when you look at the growth of the same dollar, it's roughly speaking about 90,000. So the idea is that as an investor, you absolutely have a choice. You could decide to put all the money in the S&P, but if you decide to allocate some money towards value, some money towards small companies, that gives you an opportunity, a chance to earn higher expected returns on your investments. Now, it's not a free lunch, and the biggest risk here, I wouldn't say it's necessarily the fluctuation or the risk of losing money, because you can combine enough things in the portfolio when any one of them might not be as significant. I think the biggest risk is when you implement the strategy is not to work with an advisor, because this is not certainty or guarantees at all. Yeah. I mean, you talked about this evidence-based approach to investing. That's basically what this is. This is basically looking and saying, I see this in the data, but how often do I see this happening? Does it happen every day? Well, I expect it every day. I expect every day that's going to be the case, but it doesn't mean that's going to realize. Now, you guys are in Vermont and you have the ski resorts. Well, you expect every year to see snow on the ground when you go in January. But if
Right.
any one year doesn't realize, well, that's what it is. But you don't change your expectation. And the thing is, what's fascinating is that when you look at the data, what you see is that not on a monthly basis or quarterly, but on an annual basis, you look over an entire year, roughly speaking, about 60% of the time, give or take, you see that small outperforms large, value beats growth. This is the way that we expect it. So yes, these are the results that we expect, but also means that about 4 in 10 years, they're not. So 4 in 10 years, you're going to see perhaps large outperforming and value outperforming and growth outperforming. And even if you give it a longer period, about 5 years, what you see is that the odds improve. These are rough numbers. I can certainly give you the precise number. Roughly speaking, about 2/3 of the time you see the results that you expect, but 1/3 you don't. So there are a few lessons here. The first one is that if you saw these odds, well, which part of the market would you like to emphasize? It's possible that you're going to, go through a period like this when you're not going to see it. But the odds, again, if you look at the odds, the statistics, the probability, it says that, you should diversify. You should have some large, some growth, some value, some small. But you got to be careful not to maybe do it too much because you might go through even a 5-year period when you're not going to see the results that you expect. So to me, this is, very, very briefly why I believe there's economic intuition, there's data, but it's not a free lunch because it's, you should manage your expectations and, don't go and ask, well, I didn't see it this year. Has anything changed? No, this is part of what it is. And that's why this is much more of an institutional type of investing rather than retail, because you need that consistency and discipline. And without an advisor, it's really hard to do. Yeah. So that's quickly on the background, but specifically right now, when you ask, why not invest so much into these companies? Well, if you go back to what I mentioned earlier, and you have 2020 to look at, and these companies have done so well relative to the market. So the market was up nicely, but these companies did well. When you look at small value in 2020, certainly didn't seem to have kept up as well relative to everything else. And this is where I want to go, is because whenever investors see numbers like this, their first thought is like, well, let me look and invest into what did well. Again, when you looked at this, it's not always necessarily the case that you should chase what did well. And there are a few things that we can talk for a long time about this, but I'll give you a quick example. This is a quick illustration. If you go back to the 2000, you had these large stocks, Microsoft, that basically every computer was running Microsoft. Then you had GE that was making anywhere from plane engines to managing money. Cisco powered the internet. Walmart was the largest retailer, and Exxon. And back in 1999, these 5 stocks just absolutely did tremendously well. They not a little bit better than what these stocks did this time around, but you can see relative to the market, it's roughly the same. Market last year was up about 18%. Then in 99, it was 21. It was 49 versus 67. So in the ballpark. And in 1999, small value once again was lagging behind. And as an investor, if you saw these numbers, well, the first thing that you might look at is like, well, why not put more money into these? Because these seem to be crushing it. They're doing so well. Well, if you follow these investments over the next decade, what you see is that these 5 stocks over the entire following decade, they actually had a negative return. It was a negative 11%, more so than the market. Even the market was negative over a decade. But small value, which is this little asset class that didn't seem to do very well in 99, really had a tremendous contribution to the portfolio. And then if you followed another decade, you kind of see that these 5 stocks rebounded, and so did the market, but certainly not as much as small value. And to me, the reason I'm talking about this is not to suggest that let's go put all the money in small value, or I know exactly what's going to happen with these large companies this time around or over the next decade. All I'm saying is that there is a really a big point to be made around diversification and discipline. And that's kind of what we're suggesting. I don't know what's going to happen, but don't disregard an investment just because it didn't do well last year. I think that you ought to keep a disciplined and diversified approach, and you should have some of these large companies, but it still, in my view, makes absolutely a lot of sense to also have a piece of your money in small and value. And that's what the advisors do. I mean, for your specific circumstances, they build an efficient portfolio that has all these pieces built together in a comprehensive allocation.
Yeah, great points, Apollo. Thank you again. Focusing on what we call evidence-based investing, and we're not trying to put all our eggs in one basket, but let's smartly apply the data and apply the evidence to helping our investors, helping our clients do the best they can over time. And one of the other things I found fascinating by the slide you just showed is, who would have thought in the year 2000 or in 1999 that those 5 companies wouldn't continue to dominate? Just like today, everybody must be asking, how is it, Apple and Amazon and Google, those companies, and Facebook are absolutely going to continue to dominate. But stuff happens, right?
Well, yeah, and it's so interesting you brought that up.
Yeah.
Because there's a bit of a distinction between companies continuing to dominate, which is possible that these companies might continue to dominate, versus what you get in return for holding them as an investor. Because when we looked historically, again, we can go back to the 1920s and you look at the largest companies in the U.S. market, you see that if there's a gray dot like Time Warner or Altria, those are companies that are only there for a single decade and then they go away. But if it's a colored dot, they're there for multiple decades. Exxon was there for 90 years. You had General Electric there for 90 years. You had AT&T, the largest company, for 4 decades, 40 years, and in the top 4 for another 3, so 70 years altogether. So it's really possible that these companies, the large tech of today, they might continue to dominate. I have no idea. But what's fascinating is that when you look at the performance to investors, what you see is that before they got to be in the top 10, so here's the time when they got in the top 10, if you backtrack 10 years, these large companies outperform. This is the level of outperformance relative to the market. If the market returned 10%, they return 20% on an annualized basis. So really tremendous performance relative to the market for 10 years. For 5 years, it looks even better. And for 3 years, they absolutely did amazing. They outperformed the market by over 24% annualized. So on the way to becoming a top 10 company, on the way to becoming so large and dominant, they had tremendous performance, not unlike what we're seeing today. The question is, once they got to climb this mountain and they reach the peak, what happens afterwards? And what you see afterwards is that 3 years following that, the performance is still a little better than the market, but not by a lot. And by the time you look at 5 and 10 years, they start to underperform and quite significantly underperform the market. So they have tremendous performance on the way to being large and dominant. Afterwards, perhaps it's not as easy for them to grow. How much easier it is for Amazon to grow and double in size. And perhaps they become, something like large growth, which are mature, well-established companies that have a different cost of capital. So we can speculate on all this, but what the data shows is that really on the way to becoming a top 10 large dominant stock, you do have great returns as an investor. But once they got there, it's not visible in the data. They can sustain the same returns to investors. And that's kind of, it's also a little bit, you need to diversify because of, even what Gretzky said. I love what Gretzky said years ago. What made me successful is that I try to chase the puck, not where it used to be, but where it's going next.
Where it's headed. Yep.
You cannot have the next Amazon if all you do is you hold Amazon. It's just not going to work very well.
Exactly. We want to be in a position where we can capture the next Amazon and not try and speculate and guess, but we just want to own the market and own those smaller companies that over time will, the new dominant companies will emerge from there.
Yep.
I want to shift gears a little bit and talk about the economy and kind of what's going on in Washington and some of those things, because a lot of times we equate the financial markets with the economy, and sometimes I think that's a little bit of a trap because they're not exactly the same, right?
Right.
But before I go there, maybe I want to talk a little bit about some things I hear on people's minds around government spending, and how should we be thinking about the impact of government spending on our portfolios as investors? How should clients be thinking about that? Because it certainly is true that the government is spending a lot of money.
Yeah, no. So there are two or three questions there that I think all great questions. So let's start with the idea of the stimulus and the impact on the markets and the economy. Then perhaps look at some of the risks associated with this spending, and then lastly, kind of maybe wrap up with this big picture, which is the seeming disconnect between the market and the economy, particularly last year. So let's look at first this idea of the stimulus spending. And if we go back a year ago, and the economy kind of hit the pause button, and you had people who couldn't go to work because we're all stuck at home. And let's say there was a family there with a couple of kids, and they were used to getting a pizza on a Wednesday night. But because now the parents don't have jobs and don't have paychecks, they can't get it. So at that point, it's not just the kids are crying, but also because that family is not buying the pizza. Well, the local pizza shop on Main Street, they don't have money to pay the employees. And then the employees can no longer go and buy some shoes and go buy whatever else they might be getting. And at the same time, the pizza shop is no longer buying the flour or the veggies or the meats, whatever else they might be using there. So the thing is, when the economy really stopped last year, the problem wasn't just immediate that the kids are crying because they're not getting the pizza, but it was this idea that it could potentially snowball into a much bigger problem. So the idea of the stimulus from an economic perspective is to plug the hole, put a backstop so it doesn't get degenerate and snowballs into something bigger. So in that respect, a lot of economists do agree that the stimulus was necessary. Whether it was spent in the most wise ways possible, I'm not going to debate that. But I think the idea of the stimulus, nobody wanted to, it wasn't anybody's plan A, but given where we were, I think a lot of economists agreed that it was necessary. Now, one of the risks, moving on to the second question, and by the way, what does stimulus do? Well, it certainly helped the family because now the parents had the money to, and the kids are stopped crying because they got the pizza. But it also helped Main Street businesses, small businesses, because consumers still had money to spend. At the same time, it also helped the stock market because some of the money was spent on products that came from these large companies that are part of the stock market. So the stimulus really helped households. It helped small businesses. It helped large businesses. So overall, it was a positive for the economy. Now, obviously the issue there is, how do we pay for this, and could it create risk? And the big risk that people are looking at right now is, and you hear a lot in the media, is around inflation.
Right.
Is it possible that we're going to see inflation? And let's start with just the basics. What is inflation? Inflation is the tendency of prices to change from year to year. And historically in the US, we have seen inflation. So inflation has been with us for a long time. The long-term average of inflation in the US has been about 3%. So it's a good number to know. That's the long-term trend in inflation in the US, about 3% growth. So if you bought a pair of speakers for $100 last year, well, this year they would cost $103. Is that problematic? Absolutely not. In fact, is desirable to have some level of inflation so the companies can charge more for their products. So in that respect, inflation has been with us. Is not really something that is tremendously horrific, but people are concerned right now, and just even the Federal Reserve has a target of roughly about 2% inflation. So you have the long-term average of about 3%. The Fed put a target of about 2%. So in the range of 2 to 3% is actually something normal and even desirable. And I think a lot of folks are wondering right now, well, with all this money, could it be that the inflation might spiral out of control? So maybe go way beyond 3%, 4%, whatever the numbers they might choose. And there are a few ways to look at it, Michael. The first one is that it's good to understand what drives inflation, particularly when you have these big influx of cash coming in from the government or the Fed. And
Right.
if we go back 12 years ago was the financial crisis. Once again, we had a stimulus put in place, not as big as this one, but the big one was actually a program put together by the Federal Reserve Bank, the Fed, which is called Quantitative Easing. And over 5 years, between I think in 2009 and 2014, roughly about $4.5 trillion, pretty much, what we spent in this stimulus this time around was put in the economy through quantitative easing. And 12 years ago, we had a very similar question. Well, surely this is going to, drive inflation, out of control. This is going to be horrific. Inflation is going to skyrocket. Well, if you look over the past 10, 12 years, the average inflation in the US since quantitative easing was put in place has been about 1.5%.
Yep.
Half the historical average and well below even the Fed's target. So how is it possible that even though we had $4.5 trillion put in the economy through the Fed programs, we didn't see inflation? Well, the answer, in my view, and this is my personal opinion, is that when you look at the inflation, there obviously the consumer spending and the businesses buying things, and that's kind of the demand side. But there's a second side to inflation, which is the economy's ability to produce, the supply side. And the reason it's important is because inflation is not always tied to the dollar bills available. So let's make it real. Let's say that I manufacture pens, and this is my business. So I have a number of orders coming in. I make the pens, ship them out, everything's good. Now, because of the additional dollar bills, I get more orders for my pens. And here's the thing. If I have the capacity to produce the additional pens, I just make them, ship them out. I don't have to raise prices, and I just make more money. The issue becomes if I reach capacity. That's where the issue becomes. If I reach capacity, I can't produce any more pens, or it costs me a lot more to produce them. That's where inflation comes from. So when you think about inflation and what happened after the financial crisis, a lot of economists are pointing to the fact that the economy had a tremendous capacity, even beyond what economists consider to be full capacity. So the economy could produce and not have to raise prices. Now, this time around, and the reason I think it's an important lesson going back is that this time around, where we are in this moment in time, what we do see is that there are some constraints on production in the short run. And some of these constraints have to do with the coronavirus, because not just in the US, but around the world, there are a lot of protocols. There's still so many folks who are hurting and so many parts of the economy around the world which are not open. So there is a constraint in the short run until we get over this pandemic. Beyond that, there are other things that have happened just randomly on the supply side, and I'll give you two examples. One is we all know about the shortage of chips for cars. Yep. And right now, all the cars the prices are up 10, 20% just because there are no chips. And in the short run, until, whatever number of months until the production resumes, then we are going to have these higher prices. But it's not because of the dollar bills. It's just because of the supply of chips. Similarly, my neighbors have been doing construction for a while. And when they started construction, remember they told me that a 2x4, which is used in construction, was about $3. Today is about $7. Yep. And it had a lot more to do with the Canadian lumber mills shutting down, expecting no demand, and then now trying to get back online and hiring people. And it's a process. So in the short run, there's certainly some capacity constraints. And this is what you hear a lot about. You hear from the Fed, you hear from the Treasury that it's a short-term issue with inflation. But again, nobody knows. This is based on what we know today. But just to wrap this up, there is a place where all of us can go and not read an opinion piece, not look and say, well, what does X and Y believes on this issue, but really much more precisely look at how investors vote with their dollars. You know, how Harvard MBAs and, you know, Yale PhDs, how are they investing in bonds in a way that sends a signal about their expectation of inflation? And there's a way to see that. And the Federal Reserve actually puts this out. It's a website that's maintained by the Federal Reserve. And I have to say, it's a very good website. And that is called the 5-year break-even rate. And the 5-year break-even rate, inflation rate, it kind of shows, based on how assets are priced, the market is sending a signal. And right now, I'll share with this, Michael, so you can forward it to everybody on this call. Sure. What you see right now is that the 5-year break-even inflation rate, which is what market participants expect inflation to be on average over the next 5 years, it's about 2.6%. Which is higher than we've seen. We've seen about 1.5%. So this is higher than we've seen, but certainly not outrageous, certainly in the 2 to 3% range that is actually desirable. So to me, based on everything we know, all the expectations, the market's sending the signal that we do expect in the short run to inflation to be a little bit greater than it's seen in the past, but nothing horrific. And then if you look at the 5 years and beyond, 5 to 10 years, the expectation is that inflation will actually decline back to about 2% 5 to 10 years from now. So in the short run, perhaps a bit of a higher inflation, but then beyond that, it's kind of coming back to the about the 2% range. And that's based on everything we know right now. That's really important to know. As new things come up, new information comes out, these market participants will adjust these expectations, and this rate adjusts. And as you'll see in the link that I'll share with you, you can actually get a good sense. Maybe I can actually share with you. Not really right now, but anyway, you get the point. Okay. that you know that's why some folks are concerned about inflation right now in the short run to be a little bit higher, not tremendously higher, but it's much more on the supply side rather than being related to the stimulus.
So I wanted to ask a follow-up question in the time that we have left, Apollo, and I want to thank you because our time is flying by, and thank you. It's been so interesting. But there are a couple of other things I want to try and get to, and one has to do with bonds and the role of fixed income in the portfolio for our clients, because on the topic of inflation, that may have an impact on bond prices. And you know, are we in a period where we're certainly in a period of extraordinarily low interest rates? And sometimes clients ask me, why should I be investing in bonds or bond funds when the interest rates are so low? And, you know, is it possible we may be coming into a period of rising rates? So talk a little bit maybe about, I know I just threw a lot of questions at you, but talk to me a little bit about the role of fixed income in the portfolio, and should investors be investing in bonds or bond funds today with such low rates?
Right. So that's a great question. So when you look at a portfolio, and I think it's a really good way to think about goals and portfolio as a whole, I would say that there are two very, very distinct types of investments that you can make. And we talked about stocks quite a bit. And as I said, over the long run, in the US, the average annualized return in the S&P 500, going back to the 1920s, has been 9 to 10%, but quite a bit of volatility, quite a bit of choppiness around the average. So really, it's important to know that the average is just is something that you don't really see very
right.
often. But it's been a very rewarding ride because you get ownership in these companies. As I mentioned, $1 invested in 1926 by the end of last year would have grown to about $10,000. So that's one part of the portfolio. What you're mentioning now is bonds, and bonds are different because bonds are about lending. You're lending your money to corporations and governments. There's a contract that specifies the interest rate that you get, for how long you'll get it, and then you get your principal back. And if you look at probably the one that is most commonly known as a very short-term and also also with a good creditor, the U.S. government, and that is the U.S. 30-day Treasury bill. If you look over the past 90 plus years, there has never been a single negative calendar year when you would have lost money. In fact, you would have stayed ahead of inflation, and you would have earned about 3-4% in these bonds again, with no negative calendar year of return. So to me, when I look at bonds, I think that the first thing is like, what's the role? I know that the stocks are good at growing the assets, but the bonds tend to be more about stability. And it's almost like if you go sailing, if you put the sail up, you're going to go fast, but it's going to be all over the place. That's what stocks do. Bonds are more like the ballast. They slow you down, but you get stability. So to me, the reason it's important is that if you're close to retirement or you don't have the stomach, the appetite, bonds still are probably one of the best ways to diversify from stocks, because not only that bonds have not really had tremendously negative returns, but what's also interesting with bonds is that they tend to do well when the stock market doesn't. So if you go back to the beginning of last year, the stock market was down almost 20%. This U.S. government bond index was up about 8%. So in that respect, it's not just last year. If you look over the past 20 plus years, in every single case when the stock market dropped significantly, these bonds held up really well, really well. So to me, what this is suggesting is that one of the roles of the bonds is to mitigate and be a diversifier when the stock markets might actually not do very well. And historically, as far as I know, bonds have done a tremendous job, and better than anything else that I can think of, in terms of counterbalancing periods of downturns in the stock market. So if you think of the role of bonds as being a counterbalance to stocks, particularly when they're not doing well, they've done their job, even in low interest rate environment. What else do you have? I mean, that's the best that we have. Now, sometimes people look at bonds also as a way to maybe generate income. And they're saying, well, I'm not getting much in interest. Again, traditionally, bonds were never really supposed to be that much of a growth engine to the portfolio. And I think to see that best, Michael, if you take the exact same dollar and you invest it in the 30-day Treasury bills over the same time period, the Matrix book tells us that over the same time frame, the same dollar invested at 3-4% would grow to a whopping $22. $22, nothing more than that.
Right.
So again, if you look at bonds, it's not really about the the growth in the bonds as much as the stability they provide, and that's where it really helps to have a financial plan to figure out how much do you want to put in stocks, how much do you want to put in bonds. It's one of the most important decisions in investing, and in that respect, if you do need to generate some money, it's more about the cash flow. Every year you need a cash flow, and this is what Michael and the Copper Leaf team do. They kind of look and say, how can we generate cash flow from your portfolio? And at times it could be from bonds. But when the stock market's doing well, perhaps at that point, the cash flow can be generated from stocks as well. Right. So you don't have to have the bonds just for income. In fact, it's probably a better way to look at a comprehensive portfolio. Look at your financial plan and realize that the role of the bonds tends to be a lot more to give you a cushion, to be a diversifier when the stock market's not doing very well.
That's exactly how we talk about it and how we think about it. And thank you for that excellent explanation, Apollo. Well, listen, we've reached the end of our time, and I don't want to keep you. I know you're a busy guy, and you're going to be on to something else. But I want to thank you so much for joining us today. It's been a pleasure and an educational experience as always. And I want to remind our participants that. Join us next month for our next session. If you have questions, please let us know. And we also love your feedback always to hear your input and topics that you'd like to hear in the future. And if you'd like to hear Apollo again, we'd love to hear that because we'd love to be able to invite him back. I think we've actually got him queued up for later in the year. So thanks again, Apollo. Thank you everyone for joining us, and have a great afternoon.